Good afternoon, members. We'd like to welcome you to the 5th session of the SARS Interpretation Update and Case Law webinar. For new and returning members, you'll remember that this particular webinar is dedicated to updating all attendees on submissions that SAIT has undertaken in the past month, as well as to discussing case law where relevant or other matters such as queries which we have received via our tax helpline. So just kicking off with regards to the draft guide. So the draft guide, of course, deals with the net-billing tariff system for excess power generation. We just set out some of the detail that was actually put in the actual guide, just for a quick reference point. You will know that the guide also speaks a lot to the NERSA regulations, or the National Energy Regulations of South Africa. So certain terminology that's used by the NERSA is also used in this particular guide. So the purpose of the guide is to provide general guidance on the tax treatment of credits that are due to taxpayers for excess power generation from renewable energy sources, and that which is then exported via the grid. So the guidance, as per the draft guide verbatim, is also provided on the tax treatment of the various expenses that are incurred by a taxpayer in generation of electricity. The customer doesn't sell the excess power that's generated, but is of course at all times the owner of that energy that is generated and exported or stored on the grid. And because it's not sold, the excess power isn't sold, the customer or the person who generates that additional electricity doesn't of course receive any compensation or payment. Now, the customer of course will have their monthly electricity bill, so they're still charged the full tariff for the amount of energy that they consume and the capacity that's provided. However, such a person who exports excess power as a result of electricity generation receives a form of credit for the electricity that's exported, which is then calculated using the export tariff method that's approved by the NERSA. Now, flowing from the net billing framework is the basis upon which this billing system operates. So NERSA refers to what we call a prosumer, and it's also defined in the particular guide as a person who then generates that electricity. Now, a prosumer is not paid in cash, as we did discuss in the preceding bullet number 3, that you're not compensated for this excess electricity that you export to the grid. However, as bullet number 2 reiterates, your electricity will be, your current and future electricity purchases will be credited with the financial value of the kilowatt units from the distributor against what you have exported or stored on the grid. Now, if your bill in a particular month, for example, exceeds the available export credits in a specific billing period, these credits are then rolled over on a month-to-month basis. And just verbatim, as stated on the slide, the rollover works as follows, in that the prosumer must be billed the applicable charges, but only the charges relating to the kilowatt units relating to the energy part of the bill can be offset with export credits. And then these credits, of course, can be used against the charge of electricity usage, and they cannot be set off against the fixed charge and non-energy portion of the bill. So that's just how the rollover process works. We do understand this is a very technical, it's a very technical portion. It's not something that falls, as I mentioned, within our purview as tax people, but that's just the framework upon which this particular draft guide was drafted. The eligible forms of renewable energy. So if you have a client or yourself would like to participate, of course, you do qualify for this net billing tariff system. The only eligible forms of renewable energy that will be accepted will be, of course, the wind power, solar energy, which is one of the big ones, as we had discussed, for example, earlier on in the introduction, that, solar energy is becoming a big thing because of load shedding. Eligible forms also include water, biomass, geothermal energy, and renewable fuel cell resources. So only those forms of renewable energy that are used in the generation of electricity will then qualify for this net billing tariff system. And then there are certain implications, value-added tax, as well as income tax that will flow therefrom. So that will be the first point of call when a client does come to you, is to assess the energy that is being used to produce this excess electricity. Now, just the last point before we hand over to David, persons who are eligible to participate in this net-billing tariff include both natural people and juristic persons, but this only includes persons that do not conduct any trade and persons that do conduct a trade. So both natural and juristic people that do conduct a trade and don't conduct a trade can qualify for this particular, are eligible to participate in this billing tariff system. Individuals, for example, that install renewable energy generation technologies to their residential properties and to commercial properties may also qualify or participate equally in this system. I'd like to hand over to you at this time, David.
Thank you very much, Keitumetse. The fun part about that is we distinguish between trade and non-trade. Those people who are in employment do have a trade. It's not that they don't have a trade. It's just that they have certain restrictions because it's employment. But there's the people who call them employment, the man in the street who's put up something, and then there's the businesses. So the draft note addresses both of these. And firstly, it does get it correct as far as I'm concerned. Sounds a little bit arrogant, doesn't it? But it does set out, as far as I'm concerned, correctly what the tax situation should be for each of these people. Maybe not as clearly as it could be. So we start, let me address both types of persons separately. We've got our man in the street, living at home, the householder who has put up something, is not running a business and everything else from home, has just put it up and gets this credit. As we've been talking about it, it is a credit. The concept is that if you generate something, we mentioned the battery. I'm struggling with the concept. I understand what they're saying, but doing a little bit of hobbyist electronics, feeding electricity back into a system is not the same as storing in a battery, although in concept, I understand what they mean about it. Because if you're storing in battery, you're storing. When we feed our electricity back into the system, it must be consumed or lost. There is no storage. But what they're saying is if you feed it in, we'll keep a record of what you fed in, and we will give it back to you at a future point. But we'll give it back to you at a lesser rate than you got in. That's the fun part. And on the VAT side, what's going to cause some interesting things. So if we are charging you, if you use 10 units and we're charging you, I think, I can't remember what the examples we're using in the draft note, but we're charging you R2.40 for it. If you feed us 10 units, we will give you R2 for it. So that obviously, if as a credit, I will get back less units if I've translated into financial terms and then back into, call it physical terms, electrical terms, because the 10 units I have given them have less value than the 10 units I've used. So again, as I say, from a VAT perspective, I think there's going to be interesting configuration of systems.